semester on managing your money to build your best life. My name is Kirk Martirosyan, Senator of Finance at ASGCC, and I want to thank you all for coming this afternoon. I would also like to thank all the people who are new members of our financial literacy program who will attend multiple sessions and obtain a certificate of completion at the end of the program. I would like to let everyone know that closed captioning and ASL interpreting are both available today. We have our interpreters Kim M and Kim W listed as interpreters, and you can pin them by pressing the three dots in the corner of their video and pressing pin video. We also have our captioner Sean, who is going to be providing us with closed captioning. You can access closed captioning by pressing the button at the bottom of the screen labeled CC. I would like to remind everyone that there is going to be a $300 in Amazon gift cards being randomly given out today and at each of the financial literacy events. Please fill out the form at the end of the session, which will be put in the chat box 5 minutes before the end of the event. If you are part of the financial literacy program, this is a required component in order to receive credit for attending today's event. Any questions that come up during the presentation about the financial literacy program can be sent to our ASGCC Senator of Finance, Arthur, named questions in the participants menu. Without further ado, I would like to introduce our presenter today, Dr. Jennifer Bethel, a professor of finance at Babson College and the faculty director of the Babson Financial Literacy Project. Dr. Bethel served as the chief economist for the Division of Corporation Finance at the Securities and Exchange Commission and later consulted to the Division of Economics and Risk Analysis. Dr. Bethel has a bachelor's of Business Administration from the University of Texas and a Master of Arts in Economics and a PhD from UCLA. Welcome, Dr. Bethel. We are glad to have you here today.
Thank you, Kirk. I am delighted to be here, and I'm delighted to see so many of you here. That absolutely is the high point of my day. So what I'd like to do this evening is talk about managing your money. For a lot of people, managing money is stressful. And I hope by the end of our session this evening, you see a path, you see a way to make it a whole lot less stressful in your lives. I'm going to start by having a quick poll. And it's just kind of to get a sense of where we all are. So I just launched it, and it's 3 questions. Question 1 is, what's a good minimum balance to keep in your emergency savings fund? Question 2 is, what is a savings rate that will likely ensure you have a comfortable retirement? And the 3rd question is, how well do you understand what you need to do to plan your finances for the future? So if you'll just take a moment and answer these 3 questions, please. By the way, I love to see you. If you would turn on your camera, that would make me so happy. We also welcome questions in the chat as we go along. Sometimes there's questions I don't see, and so I've asked Kim Campion, who is here this evening from the BFLP with me. She's going to be monitoring the chat, and I'd also love the senators from Glendale to also help me with that. Okay, we're still getting some responses. The more interactive we are, the more fun this evening will be. By the way, I always give a little disclaimer at the start. So as Kirk said, I'm a professor, so I'm all about educating. I actually am not about advising. To advise someone, you need to know their personal situation. And obviously, I don't know your personal situation. So in the spirit of that, this evening, what I'm going to be doing is sharing rules of thumb, best practices, ways to think about budgeting, some of what I'm going to say, you're going to think, Jennifer, are you nuts? This makes no sense at all to me. That's quite possibly true. Other things I'm going to say, you're going to be like, oh, I always wondered what I should do about that, or what might be a good way to think about it. So as I say, I'm not advising this evening. I'm here to help you learn more about budgeting and how it can make your life a little better. Okay, I'm going to actually stop the poll. It looks like most folks have had a chance to answer. I'm going to share the results. So what's a good minimum balance to keep in your emergency savings fund? We don't have consensus. We've got lots of people with lots of different answers. And tonight we're going to talk about when you think about your emergency savings, what's a good target, at least for a lot of people? What's a saving rate that will likely ensure you'll have a comfortable retirement? Again, very dispersed answer on this, and we're going to talk more about that as well. And the reason you're here is because you want to know more, and so I'm not at all surprised with your answers to the third question. Okay, and with that, let's get started. So what are we going to do tonight? The first thing we're going to do is we're going to talk about how to develop a financial plan. We're going to use this simple infographic. And the infographic is, we're going to start with your after tax, your earnings. We're going to take out your taxes. We're going to take out your savings, and we'll talk about why that comes right after taxes. And then we're going to you're going to take out your essential expenses. And then what's left over is passions, right? This is maybe we want to travel. Maybe we want to go buy that new iPhone 12. You know, these are the things that are what I would call discretionary. And so then we're going to actually look at a financial plan with the hopes that you can, once you see a financial plan, you can go back and quote, fix it for yourself so that it reflects your reality as opposed to the reality of the young man we're going to look at this evening in terms of his finances. So let's go back to this earnings, and we're going to talk about potential sources of earnings. So in the chat, where does money come from for you? So if money comes into your house, where does it come from? Where do you get a check? Work, absolutely. Unemployment, wages, maybe your employer, grants, the government. Yep, a lot of folks are getting stimulus checks right now, allowance, scholarships, inheritance, maybe some investments. I see some answers that go towards investments. You've got stocks, that's investments. Let's see, retirement, rents. So maybe you have some income properties. Maybe a business. Yeah, all of these are great answers. I'm looking to see if I've missed anything. Up here, maybe we've got some tips. So what I want to focus on for just a moment is what's taxable and what's not taxable. So for example, work, that's always going to be taxable. And so you're going to have your federal income tax, you've got state income tax. Depending on where you live, you might actually have some other types of income tax. Unemployment, grants, government, usually those are not taxable. Allowance, this kind of goes into a category. I'm going to also put in here gifts, right? Sometimes we get gifts, so maybe that's money that comes in. That's not taxable. Scholarships, grants, For the most part, those are going to be not taxable. The exception is if you have scholarships or grants for certain types of like room and board, then that might be taxable. So for example, if you look at four-year colleges, room and board is typically taxable. And I've had a lot of students come to me at the end of the year and say, what the heck? I didn't know it was taxable. And now they owe taxes on it. Inheritance, it's not directly taxable. There are some taxes, but for most people, inheritance is not a taxable event. Investments, absolutely. You get taxed on any income. So that would be any interest income, if maybe you get dividends. If you sell an investment and have a gain on it, then you're going to have some taxes. Income property, yep, taxable. Businesses, yep, that's going to be taxable. So what we're trying to do here is we're trying to create two buckets, a taxable bucket, a non-taxable bucket. Because when we come up to this little tiny picture up here in the corner, we're going to start with your earnings or any amount of money that comes into your life. And we're going to take out of it taxes, because what we're trying to do is we're trying to get to your after-tax income. So the money that comes into your life after tax. The one thing that I do want to spend just a few minutes on has to do with different ways you might work and how that's going to affect you. Any questions so far? I get all excited and then I forget to ask for questions. Okay. So there are two ways to work. One is I'm going to call it W-2. The other one, I'm going to call it 1099. This W-2 is, actually, let me put a quick poll in. Let me see. Actually, I won't. W-2 is working for what we think of as like an employer. So this is where you go to work, you have a boss, you get a paycheck maybe every 2 weeks, maybe it's once a month. When you get that paycheck, you look at it and say, oh my gosh, somebody took a whole lot of money out of my paycheck. That's a W-2 employee. A 1099 employee is not really an employee. That's called an independent contractor. You are your own boss. So for example, if you, right now still, even in California, if you drive for Lyft or Uber, you're your own boss, right? I'm both a W-2 and a 1099 person. So I work for Babson College. That is a W-2 job. I also consult. I have no boss. I am the boss. That is my 1099 work. So it's not that one is better than the other. They're just different. So how are they different? Well, when we think about the money that gets taken out of your paycheck, we start with federal income tax, state income tax, and then we have something called FICA, the dreaded FICA. And FICA is made up of two things. One is a Social Security tax. And Social Security is that money that you receive starting anytime between, say, age 62 and 70. So these are those, maybe if you have a grandparent who gets their Social Security check, and they get it every month, and it's based on what they earned previously in their working life. The total that you're going to be paying somehow, some way, is about 12.4% of your income. The other is Medicare. And Medicare is the medical system for people ages 65, maybe, 65 and above. And you're going to have to somehow some way, pay 2.9%. So if you kind of add this up on your fingers and toes, you see like almost 15% of your paycheck just goes to FICA. That's not the federal income tax or your state income tax. So why do I care? The reason I care is depending on whether you're a W-2 or a 1099, it's going to affect A, how much you pay, and B, how it gets paid. So with the W-2 for your FICA, you're going to split that with your employer 50-50. So your employer for Social Security is going to pay half, or 6.2%, and you are going to pay 6.2%. So when you look at that paycheck and there's a lot of money out of it, it's because your employer has taken out 6.2% and paid it for you. By the way, they have paid their own 6.2%. For Medicare, your employer, again, it's going to be a 50-50 split, is going to pay 1.45%, and you are going to pay 1.45%. So your employer not only shares it with you, but they also take care of the paperwork. You're going to have some federal tax, some state tax. The beautiful thing about being a W-2 worker is your employer is going to have you fill out what's known as a Form W-4. That's going to estimate how much tax you're going to owe, and they're going to withhold that for you. They're going to put it aside. They're going to pay it to the government for you, with the hopes that when you come around time to pay your taxes, you've already put away enough money to pay your taxes. Maybe it's off by a little bit, but it should be pretty close. The other thing that's nice about being a W-2 employee are benefits. What kind of benefits do employers give out? If you'll put it in the chat, what are some benefits? Healthcare, absolutely. Vision, yep. Dental, 403B, 401k, I love these numbers. Social Security, life insurance, discounts. Yeah, so a lot of employers are gonna help you provide some retirement. They might subsidize or even pay all of your health care. No one has said unemployment insurance, absolutely. They're gonna pay the premium for your unemployment insurance. Vacation, right? That's a big one. So there's all these benefits that come from being a W-2. 1099, your employer only treats you as well as you want to treat yourself because you are the employer. So when we talk about FICA, no one to share with. You get to pay all 12.4%. When we talk about Medicare, you pay all 2.9%. Moreover, you have to pay it. There's no one who's doing all that paperwork for you. When we get down here to the federal and state taxes, every time you start work for a new client, you're going to give them a Form W-9, and that just alerts the government that you're making money. At the end of the year, you're going to get 1099s that it's going to tell the government exactly how much money you made. There's no one to withhold your taxes in this world except you. So the government requires 4 times a year or quarterly that you pay the taxes that you think you will owe the following April. So you're going to need to pay estimated tax 4 times per year. In terms of benefits, the only benefits you're going to get are those that you pay for yourself. So it's not that one is better than the other, it's just, it's different, right? Some people love being a 1099, an independent contractor, because they have no boss. Last thing they want is a boss in their life. But it comes with some responsibility. So when we think about this after-tax income, we need to make sure that we're taking into account, it's super easy to be working for Uber or you know, I have a number of friends that have landscaping companies, and you know, when they were younger, they kind of went off and did their landscaping thing. But it's really easy just to spend whatever money comes in. But you have to remember, you've got to be putting this money away for FICA and for your federal and state tax. Okay, any questions? Okay. So we talked about earnings, we've talked about taxes. Yes,
Dr.
Noah.
Bethel, I believe that some people need a little bit of time just to type really quick before they get some questions in.
Okay.
Yeah. The last time you asked, there was some late questions, so I just want to let everyone know.
Sorry about that.
No worries. Yeah, just want to let you know.
What's written next to estimated tax? You can't read my handwriting? Are you kidding? I won an award for it. That would be a 4 times per year. QuickBooks holds taxes automatically. You don't need an employer. Owning a business makes 1,000,000 times more than a job ever would. So someone obviously is not a big fan of being a W-2 employee. Why don't we get a paper from the government saying exactly how much we owe in taxes? Part of it is they don't know how much you've worked. So when I have a new client, I give them a form W-9 that all that they do is they fill out like their name, their address, whatever. We don't know how much I'm going to work for them. I don't actually tell the government that until I go to pay my estimated quarterly tax. So the government actually can't see it. Whereas with the W-2, your employer is telling them all the time what you've earned, and they are calculating how much tax they think you probably will have to pay. W-4 and W-9 they're just forms. So that W-4 form and the W-9, that is that first form that you fill out when you go to work. If you work for an employer, it's that W-4. If you work as an independent contractor, it's a W-9 that you give each of your clients. Is there still more taxes to be paid after it's taken out of a paycheck? Or FICA and income tax is all we have to pay for the year? Depends on where you live. I believe in California, do you all have like a LA county tax or anything like that? Some places actually have a county tax.
We don't.
Okay. So that's pretty much it. The only thing that can happen is if your W-4 isn't filled out quite right, or maybe something changes during the year. When you go to actually pay your taxes, you might be a little over or a little under. How much is the minimum yearly earnings for state and federal taxes? I actually don't remember. I don't know for California, and I can't remember for federal. I want to say it's something around 1,000, but please don't. That's an easy one to Google. Okay. Other questions? Yeah, you've got, somebody says you have a city tax. Yeah, New York City for sure has a tax. Yeah, if you start a business in a tax-free state like Wyoming, you will still own Social Security and Medicare. You'll also owe federal tax. What you're avoiding is state income tax. So I know a lot of people love Washington State or Florida. Wyoming, it sounds like. 12.4% is the total FICA tax. So FICA is made up of two things, Social Security and Medicare. So your Social Security is 12.4 total, you plus your employer, and your Medicare is 2.9% total for you and your employer. Can you register a business? They're actually kind of picky, and there's a lot of rules about doing that. So for the general answer is no. but it's a fact and circumstance that you'll get to end up arguing with the tax authorities over. Gifts are not taxable. I think the gift tax limit is $14,000 a year right now. It's always changing. So if somebody were to give you like $20,000, you would owe tax on some of that money. Okay. It's $15,000 a year now. Thanks, Kim. Okay, so we've talked about earnings, we've talked about taxes. Let's talk about savings now. What are some savings goals that you might have? Maybe saving for a house. Yep. What else? Car, kids, retirement, maybe a business, moving out. I'm going to put that as financial independence, maybe. College for kids, an emergency fund, more school, more education. Yeah, these are the big ones. Maybe some medical expenses if you know you've got some medical expenses coming up or you're trying to pay off some medical expenses. Yeah, these are all super important savings goals. Some people would also add in, everybody's always a little bit shy about things like vacation. I don't know, maybe you want to save for a wedding. I have several friends whose kids are getting married this year and they've been saving for it. We did get married, travel. What I'm going to do is I'm going to focus on two of these tonight. And the two that I'm really going to focus on, in part because I think they're super expensive, but not because I don't think the others are important. I'm going to be focusing on these two. And I'm going to start with this emergency fund because it's one of the things that I think a lot of people forget about. And if you come up here and you look at this diagram, you'll see the first thing we take out is taxes, and then we take out savings. A lot of people will say, you know what, I want to swap this down to here. I'm going to pay my bills and then I'm going to save what's left over. It's not that that's never been done, but what I'll tell you is most people can't do that. And by the time they pay their bills, there's nothing left over to be saved. So this is about prioritizing that savings. And when we started out, we talked a little bit about this idea of worry or stress. Let me take a moment. My camera's out of focus. Yeah, this thing has been giving me a heck of a time the last few days. Sorry about that. We want to think about sort of managing that stress. And most of us don't think of ourselves as multimillionaires, but I want you to take a moment and think about this little thought experiment. Suppose you make $50,000 a year, right? That's not inconceivable, right? You're investing in yourself right now. You're gonna get better and better jobs. So for the moment, let's think about making 50,000. If you're 22 right now and you make 50,000 a year, over the course of your working life between now and the age 65, you will have earned well over $2 million. I'm gonna let that sink in for a moment. So over the course of your life, you will control $2 million. And so this is where this becomes an interesting conversation, because this is about you and your priorities. What do you want out of life? I know what I want out of life. Do you know what you want out of life? And how do you think about these priorities? So, do you want to take that $2 million and spend it all between now and age 65? Do you want to take that $2 million and spend it between now and, say, age 100? Do you want to take that money and spend it on Starbucks green iced teas? This is my fake Starbucks green iced tea. Or do you want to spend it on a house or your kids' education or going back to grad school? This is where you have to know what you want, because you set the priorities. I can't, Andre can't. You have to really think about how you want to spend that money. And if you can get that really clearly in your head, now you can start making trade-offs that get you there. And this is where the stress starts to fall away. You don't even have to think. You don't have to make choices as you go along, because you already have made choices. You know what your priorities are, and you have to, that's how you live your life, is to get there. So I'm going to start with this emergency savings. I think this is the #1 way to get stress out of your life. Really quickly in the chat, what kinds of things happen to you that you might need emergency savings for? Car repairs, the pandemic, car accident, car breaks down, loss of a job, sickness, natural disasters, you lose your job, surgery, medical bills, your house, your funeral, health, house issues. These are great answers. Moving, a tree falling on your home, a broken phone. Yeah, these are all emergencies. Every single one of these, it's already stressful. When you don't have the money to cover it, it doubles or triples or quadruples the amount of stress you're under. So one of the things that I'm going to try to convince you of is that one of the kindest things you can ever do for yourself is to set up an emergency savings account. And what financial experts typically advise is something like 3 to 6 months of living expenses. So I'm going to focus on this word, living expenses. This is an income. This is the amount of money you need if you lose your job or you have a huge bill. So I have a 24-year-old son. COVID hit. He used to live in Eagle Rock. He moved back to Boston, gave up the apartment. If he were to say what his living expenses are right now, 0. He doesn't need much. If we were to have the same conversation when he's 40, I think it's going to be a different number. I think one of his goals is to someday buy a house. Maybe he has other people in his life, maybe dependents. That number is going to be a whole lot bigger than it is right now. So think about 3 to 6 months. If we had this conversation a year and 3 months ago, and I had said you need 3 to 6 months of living expenses in your emergency savings fund, you probably would have said, Jennifer, you're crazy. Things are great. Why would I need that? But we've lived through this last 14 months, and I think we all understand that bad things can happen to us financially. So one of the things that I would love to see you work towards, and it's not going to happen overnight, but as you become financially independent, is to try to work towards this goal of 3 to 6 months of living expenses. So that's a long-term goal. That's not going to happen necessarily overnight, and I understand that. Once you start building that fund, you want to make sure that you have it someplace safe, easy to access, that pays you interest. That defines a bank savings account, or maybe like a money market account, something that if you need it, you can get to it, you know with certainty it will be there. Not a lot of risk, it's there. And if it's in banks right now are paying almost no interest. Interest rates are so low. But in general, they pay maybe 3 or 4%. And so it's kind of nice to earn a little bit on that money. The final thing is, if you use it, you got to put it back someday. And try to do that as quickly as you can. Okay. So that one of your big savings goals, emergency savings fund. I'm actually going to show you a short video, and this is really starting to talk about our second big topic on savings, and that's saving for retirement. So let me do that. Hold on just a minute. I'm going to Okay, here we go.
Compound interest is an important financial principle that can help you save money for your future. Albert Einstein, a genius scientist, supposedly said, "Compound interest is the most powerful force in the universe." So what is compound interest? Compound interest is the interest you earn on the money you initially invest, plus the interest previously made on the investment. So how does it work? Ignoring taxes for now, imagine Sam is 22 and earns $49,000 this year. He saves and invests 15% of his income, or $7,350. If he makes 5% on his investment, he will earn $368 by the end of the year. So Sam's original $7,350 will grow to $7,718. If he reinvests the same amount for a second year, he'll earn $385 and have $8,103. If he invests for 43 years until he retires at age 65, Sam will earn over $52,000 on his original $7,350 investment and have close to $60,000. Amazing, right? What if Sam decides to save and invest 15%, or $7,350 of his income every year before he retires at age 65? He will invest a little over $316,000, but his money will grow to over $1.1 million by retirement due to compound interest. If Sam lives to age 95, he will be able to take out about $72,000 each year for 30 years during retirement. Many people find it challenging to save 15% of their income. Let's look at Jada, who saves and invests 5% of $49,000, or $2,450 each year until retirement. She will invest about $105,000 by age 65, and it will grow to over $370,000. If she lives to age 95, Jada will be able to withdraw about $24,000 each year in retirement, or roughly half of her income before she retires. That sounds tight. Many people put off savings. Let's look at Ian, who puts off saving for 10 years until age 32, and then saves and invests 15%, or $7,350 each year until retirement. He will invest about $243,000. That money will grow to over $625,000 by the time he retires. If Ian lives to age 95, he will be able to take out about $41,000 each year in retirement. Putting off savings can be costly, so be sure to start early. Many people save too little or put off savings for retirement. To have a financially comfortable retirement, it's important to keep two goals in mind. Work toward a 15% savings rate and start saving as soon as possible. The sooner you invest your money, the more you will benefit. The bottom line, Einstein was right. Compound interest is an amazing force that can help you save for your future.
Okay, so what we end up with from this is sort of this idea of how much do you want to save for retirement? And again, this is a very, very personal decision on your part. But I hope you can see that if you save too little or you start a little bit late, it just makes it tougher later on. So what do financial experts tell us? The first thing is work for that 15%. And again, it's not going to happen overnight. I'll talk to you in just a moment about ways you can get there. The second thing, start as soon as possible. Now, at this point, you might be saying, you have no idea of my situation. Absolutely, I give you that. But what I will say is that there are ways to work towards both the emergency savings and the retirement savings. So one of the things that we talk about a lot about are transitions. And oftentimes people find the easiest way to up their savings is when there's a transition in their life. So what do I mean by that? You're working one job, you get a new job that you're making a lot more money. If you could live on your old salary, try continuing to live on your old salary, but you're able to save the difference in the two salaries. Maybe you get a bonus, put that bonus towards savings. Maybe you get a raise, right? A lot of us will get a raise, maybe not this year, not a lot, but take that raise and maybe say, if it's a 3% raise, take 1% of it and say, you know what, I'm gonna put this into my living expenses, and the other, I'm gonna put towards savings. So right there, if you're trying to get to 15%, you've already got 2%. Other places that I see a lot of transitions happen are things like you share a household. So for me personally, when I moved in with friends, all of a sudden, like we went from having 3 or 4 people in an apartment, having 1 or 2 people in an apartment to having 3 or 4. My expenses dropped dramatically, right? So some of it is also reimagining how you live. And again, you can't turn on a dime, you may have a lease, but thinking about how you take your life, you keep what's good in it, but you look for these transitions where maybe you can increase your savings. The other big one, and we'll talk about this later, is if you're a W-2 employee, you can, many employers will help you on your retirement. So they'll do something like, you save 1%, the company saves 1%. If you save 2%, the company saves 2%. And so on until you get, so for example, a pretty generous company might be, you save 5%, we save 5%. I work for a university, a college. Colleges are known to have bad pay and great benefits. So for me, if I put in 3%, my college will put in 12%. I'm at 15, right? So that's the other thing to look at when you're looking at different job options. Be sure you include the value of those retirement benefits because they can really help you. Let me take a moment. Anyone in the chat, what are other ways that you have found helpful to save money? So someone said if they do, their company does a 50% match. Hiding it from myself, don't eat out as much. I don't know about you all, but through the pandemic, I don't eat out very much and I've saved a ton of money. Split entertainment, invest in properties, be sustainable, staying home, making coffee at home, buying at the 99. A lot of people find they can save a lot of money with coupons. It seems like something that, you know, old people do, but coupons are amazing. I see a lot of great answers here. Yeah, so here's my green iced tea. I used to, every day on the way to work, I walk by a Starbucks, $4.23. I'll show you later that over 10 years, my green iced tea has cost me over $15,000. Like, that's insane, right? So I found the secret recipe, and now I can make Starbucks green iced tea for myself. Yeah. So there's all the things we do that are small that add up to big. And then there's some just big ones that we can just do. Okay. I'm going to put into the chat. I believe they sent you some cases. And so I'd like for you to download Saving to Meet Your Goals. And basically, this just goes over what we just talked about. I'm going to put it in so that you have it. There you go, just in case. Let's see. Oops, you know what? Everyone in meeting, there we go. There we go. So this goes over what we just talked about. So the next thing that comes out are these essential expenses. What are your, yeah, there were 4 files. We'll get to the others in just a moment. What are your essential expenses? Really fast in the chat. Rent, car loan, food, car, transportation, mortgage, gas, utilities, bills, insurance, food, clothing, medical insurance, car payments. Yeah, so I'm seeing a wonderful list. Those are your essential expenses, but I'm going to make a distinction. Needs, wants. So if I were to say, I saw someone in there, some folks said phone. I would agree with you. A phone is an essential expense. A want, iPhone 12, right? It's a phone, but there's a want component of it. So when we talk about these essential expenses, these are the expenses that you absolutely positively need in your life. So for example, we could talk about we need clothing, but we probably don't need a Louis Vuitton purse, right? That goes into passions. So we're going to start by thinking about these essential expenses and then about the passion. Somebody asked about cable. So I've just been in the business over the last 2 days of paring down my Verizon bill. And it turns out like I pared off like $140 off my Verizon bill because those were passions, right? I really don't need BritBox. I really don't need an extra box in my guest bedroom. So even when we talk about like a utility bill, we have to think about what portion of it is a need, what portion of it is a want. Okay. Okay, so we're going to move towards building a financial plan. To build a financial plan, we're going to develop a monthly plan. Then once we've got that monthly plan for the next year, we're going to build a 3-year and a 5-year plan. This is to take into account our priorities. What do we want to accomplish? If it's getting married, if it's going to school, if it's getting a down payment for a car, whatever it is, now we're starting to get a little longer focus. on what we're thinking about. We're going to track that monthly plan. We're going to see how we're doing. A lot of us are just bad at planning. It's not that we're bad at living our life, we're bad at planning. So this is where we start to get good. Like every month, let's look back and say, it's not, am I a good or bad person? It's, did I estimate well? And you'll get good at estimating. And that's where we want to be. And then at the end of every year, look back. How did you do? Are you still on track to get to where you want to be, to meet those goals? Okay, we're going to do a quick exercise. What I'd like for you to do, I'm going to put a case in the chat. Let's see. There we go. Sorry about that. I'm a little slow here. There we go. So there's a case in the chat. You should have received this earlier. What I'd like for you to also do is take your phone and focus it on that QR code. I'm not sure why the QR code floated down my page, but it did. If you didn't get it sent to you earlier, you can just download it in the chat from the chat. There's nothing in the chat. Kim, can you see the case in the chat? Let me put a, if you can't get the QR code to work, you can also download it with this link. So once you download the link, you click on the link, you're going to have to make a copy or download it. It depends on what operating system you have, because you won't be able to edit it unless you download it. Okay, it looks like some folks are able to get it. So the first thing I want you to do is please download the case and save a copy of the Google Sheet. Excellent. Okay, and while you all are doing that, I am going to show you a copy of the plan. So this is a young man named Kunal. He just graduated college. I know you all are taking classes right now, but soon enough you'll be in his situation. And he's got some choices to make. He knows he really wants to try to plan because he's got a lot of things he wants to accomplish. And so what I'm going to do is I'm going to be Kunal's fairy godmother. And I'm going to let him tell me all the things that he wants to do. And we'll talk about what he wants, what's possible. Maybe you guys can help Kunal figure out. So he's going to be making $49,000 a year. After taxes and FICA and all those wonderful things, he's actually going to be making about $35,000. And monthly, he'll be making almost $3,000. So what does he need to pay for? Well, the first thing is he's got some student loans. So here are his student loan payments. So he's got to pay $327 a month. He's got a credit card. That credit card, he owes $980 on it. He wants to get it paid down because he's got a really high interest rate on it. And so his minimum payment is $28 a month. So he could just pay the minimum. But he wants to get it paid down. If he pays $93 a month, he'll get it paid down in a year. So we're talking, he says, I want that paid off. He wants to save some money for emergencies. He looks and he realizes he needs about $1,500 a month for emergencies. So if he wants 3 months of savings, that would be about $4,500 that he needs to save. So the question is how much does he want to save per month? So with $4,500, if he pays $300 a month, $400 a month, let's say he pays $200 a month into his emergency savings accounts. He wants to, his best friend is getting married and it's a destination wedding. This is really tough, right? His friend asks him to be his best man and he figures it out. That wedding is going to cost about $2,400 because he's got travel expenses, hotel, a tuxedo, a gift, a party, and it's in a year. So if it's $2,400 and he's got a year to put the money aside, that means if he wants to go, it's going to be $200 a month. But he has a choice, right? He could tell his friend, I can't fit it into my budget. But for the moment, it's really important to him. Retirement savings, he's decided at first, he's just getting started. Maybe he starts with 10% savings and his employer will match him 1-for-1. So if he puts away 5%, his employer will put away 5% for a total of 10%. So that would be $204 a month for his retirement. Here's a big decision. He can live at home. If he lives at home, he figures he should probably kick in about $500 a month, just for utilities and, cable and all those wonderful things that his family has, but he feels like as a fully employed person, he really wants to try to kick in. The alternative is he's got a friend who wants to get an apartment with him. If he gets the apartment, his share is going to be $950 a month plus $95 a month in utilities. He really wants to move out of the house, but for the moment, we're going to let him have the apartment. Commuter rail pass. His new employer will give him a discounted commuter rail pass for $320 a month. And it turns out that commuter rail goes near his family's home and right down to work. In the past, he has spent about $260 a month on groceries. That's his best guess, but obviously he could spend more, he could spend less, right? Maybe now that he's making almost $50,000 a year, maybe he eats a little nicer food. It's also a time when maybe, he tries to save a little money. So for the moment, let's just leave him at $260. He estimates personal expenses at $150. His cell phone contract is $45 a month. Clothing, new job, really needs a professional wardrobe. So he'd like to try to spend a little bit of money on clothing. In the past, he spent about $100 a month on clothing. So if he wants to up it, I don't know, maybe $200. Health club membership he used to spend about $30 a month. He feels like, he's got an income, so he kind of wants to do a little bit more. Let's maybe say 40. Health club membership, there's a stripped down one, or he could go to a really nice one, or he could skip it. By the way, he lives in New England. Skipping it all year round is going to be a really tough slog for him. But, he really likes the nice ones, so why wouldn't he go to the nice one? Cable TV, depending on the number of channels his share. Streaming services, how many does he want? I don't know, 1, 2? He could buy a car. He would love to have a car If he buys that car, his payment would be $338, and his expenses, which would include insurance, gas, not a lot in repairs because it would be a new car. Social activities, what does he want to do with his life? So he figures maybe, I don't know, maybe go out twice a week. So that would be 8 times a month. Cost per activity, maybe 25. And then he usually doesn't drive after he goes out, and so he does ride shares. Okay, so where does Kunal end up? He's about $1,200 short. So what I'd like for you all to do is, I actually can't see the chat right now. I would love for you to tell me how you want to help Kunal balance his budget. What do you want him to do? I've gotten to play nice because I let him have everything.
If you all put it in chat, we can read it out loud for Jennifer since she can't see the chat. And Kirk, maybe you can read a couple of those out.
So no health club membership, stay at home, less the streaming channels, buy a reliable used car instead. Sorry, they keep moving while I'm trying to read them. That's why.
No, that's fine. I'm going to catch up. Don't worry.
Spend less on activities. For his new car, he can rent it out when he isn't using it. Cook at home. No ride share.
No ride share? We don't. What kind of a social life do we want this poor man to have? We're killing him here. He's only going out once a week.
Yeah, stop using credit card and pay cash.
Okay, but we got to pay off the credit card, right? So this is just paying off the credit card. Well, we're down. We're only over by about 500 now. What else can we do? We've picked off one of the big ones, which is he's living at home right now. Okay, I'm going to be harsh. I'm going to take the car away.
Yeah, the less fancy gym, stay with parents, no wedding, live longer at home.
Live longer at home. Nope. Oh, that's sad. I hate to take the wedding away from him. Do I have to take the wedding away?
Dr. Bethel, it's up to you.
I can't tell Kunal what to do. I don't know what he should do. The good news is Kunal's now over. He's balanced his budget, right? So he actually has an extra $100 a month in his budget, and he still gets to go to the wedding. I was dying over the wedding, to be honest. So what I want you to see is all of these are choices. And for you as an individual, you get to make these same kind of choices. So when we talk about Kunal's decision, he just has to figure out what he wants. What are his priorities? And is it his friend? Going to his friend's wedding? I mean, you could argue that's 2 days versus 363 days when he's living at home, right? Like, which is more important to him? Does he want the fancy gym, or does he want to increase his gift budget? So for you as individuals, you can now take this plan and you can customize it to yourself. You can put in how much you want. If you've got a credit card that you're trying to pay down, you can put in how much you want to pay off. You can put in your own rent. You can put in your own utilities payment. So you can take this and you can customize it to sort of suit your life, and it will help you figure out where you are with this. By the way, down here for emergency savings, Um, for retirement, here's his goal. He puts in 2450 or 5% of his income. His employer puts in 5%, which means he's putting away $4,900 a year towards retirement. So on a monthly basis, that's where we got that $204, is we just took this 2450 and divided it by 12 months. Do we have any questions on canals or building your own financial plan?
Dr. Bethel, there was a question earlier about budgeting for food. How much should they be budgeting? Because some people felt where you can't spend so little on groceries and then not eat out. Is there a right number?
There's not a right number. It depends on how you want to live your life. So I have my older son who's 24. He almost won't eat at home. He would eat one meal a day and eat it out. My other son is like super frugal. He's super independent, and he will make every meal himself. Eating out's just not a priority. There's not a right or wrong answer. I think it's a little odd to eat once a day because you can't afford to eat 3, but you know what? That's his choice. That's his life. And I'm just his mother, right? I'm just his mother. So there's not really a right or wrong answer. I think especially in some cultures, and I'm going to put a good chunk of California into this culture, the idea of eating fresh and healthy, it's more expensive, but it's healthy, right? So maybe someone who really, that's a value to them, they're going to have a higher budget. So there's not a right or wrong answer. The one thing that I will say is if you're spending more than about 30% of your take-home income on rent, you're going to find the rest of your budget is tight, tight, tight. So I'm not telling you don't spend more than 30%, but what I am saying is if you spend more than 30%, you're gonna feel the pinch in some other places. So that's kind of a rule of thumb. Okay, I'm gonna stop sharing there and come back here. Sorry about that. Okay, so when we talk about how Kunal can make his plan work, we talked a little bit earlier about ways we can save, and many of those same things are ways that we can make our budget work. How do you think Kunal's situation might be different 5 years from now? Maybe a recession. Right now, he has his parents to rely on. He might not. He could have a higher income. Absolutely. If he's getting consistent salaries, he's getting some promotions. Maybe he's got a new job. Maybe he's making more money by then. Maybe he's married and with kids. And those kids are going to suck up all his money, according to Allie. Yeah, so you can think if Kunal is looking at these next 12 months, and then he's thinking 3 years, 5 years, probably what he's looking at is some kind of income expansion. And the trick is if he can get that income expansion and he doesn't expand his expenses as quickly as his income increases, he'll go on and he'll hit that 15%. But his expense, if he ends up married with kids, he might find that in fact his expenses increase. So he'll really have to work to get that 15%. Maybe he'll change his career, right? You're the generation that they say will have not 7 jobs in your life, but you'll have 7 careers in your life. He should find someone rich. I tried that. I'm not sure I must have asked the wrong question. What can I say? I'm not sure I quite figured that one out. Okay, so now you can build your own financial plan. What I want to do now is I want to talk about how to save for retirement. So when we looked at compound interest, you could just see how incredibly valuable it is to get that money saved and invested. But it turns out that the government gives you ways to really leverage those savings. And they do it through these retirement vehicles. So I'm going to try an experiment and see how we do here. Can you guys hear that? No. Oh.
Saving for retirement is one of our most important financial goals. How do you envision your time when you are older? On a beach? Climbing a mountain? But where to start? For most people, it is choosing a retirement savings account. You can think of it as a box into which you save money and then invest. There are so many options: 401ks, traditional IRAs, Roth 401ks, 403bs, SEP IRAs, 457s. Which one should you choose? The bottom line is each can help you build a secure retirement and save taxes too. Which option you select, however, will depend on your situation. There are 2 ways to save for retirement: on your own and through your employer. Let's start with the first. If you are self-employed, your employer doesn't offer a retirement plan, or you want to save outside your employer's plan, you can set up an individual retirement account or IRA. If you are self-employed, you can also set up a simplified employee pension plan or SEP IRA, which is similar to other IRAs, but you can contribute 3 or 4 times the money. The government sets eligibility rules and limits how much money you can contribute each year. In addition, you may be able to save in an employer-sponsored retirement plan, such as a 401k. You fund your account by contributing money from your paycheck. Many employers contribute as well. For example, your employer might match you 1-for-1 up to 4% of your salary. If you contribute 4%, your employer will contribute 4%, so that you jointly save 8% of your salary. An employer match is effectively free money. Put another way, if you don't contribute up to the company match, it is the same as taking a pay cut. Any money in the account is yours and you control it. If you leave the company, you can transfer it to another retirement account. People who work for a nonprofit or the government don't have access to 401k plans, but may be offered a 403b or 457 plan. These plans have many of the same features as 401k plans. One big difference between IRAs and employer-sponsored retirement plans is who is eligible. IRAs, for example, have income-based eligibility requirements. Not everyone can have one. People who earn a lot of money, for example, may not qualify. With 401k and 403b plans, your income doesn't affect whether you can contribute, but you must work for an employer that sponsors a plan. A second difference is the amount of money you can contribute. Unlike SEP IRAs and employer-sponsored plans that are designed to help people fully fund their retirement needs, you cannot contribute nearly as much to an IRA. People who are funding their retirement through an IRA may want to save money elsewhere too. Retirement plans can help you reduce your taxes. How great is that? But how? Let's begin by looking at traditional and SEP IRAs as well as employer-sponsored plans. You contribute a portion of your pre-tax earnings to your retirement account. If you have a 401k or 403b plan, your employer may contribute as well. What remains is taxable income, which is now lower. You then pay your taxes, which leaves spendable income. You only pay taxes on your retirement plan contributions and earnings from your investments when you withdraw them in retirement. If your tax rate is lower than when you earn the money, you will save on taxes. You will also delay paying taxes on investment growth until then. Alternatively, you can put after-tax money into Roth IRAs and Roth 401ks. After paying taxes on your earnings, you contribute to your retirement account, leaving spendable income. For a Roth 401k plan, your employer may contribute matching funds. Because you pay income taxes on your contributions when you earn them, you will not pay taxes later. Not surprisingly, Roth accounts are often preferred by people who expect to be in a higher tax bracket when they withdraw money than when they earn it. Retirement plans are a great way to help people save for retirement and have many benefits, but there are penalties if you withdraw the money early. For most IRAs and employer-sponsored plans, you pay a 10% penalty in any taxes you owe if you withdraw your contributions or earnings before age 59 and a half or after 72. For a Roth IRA, you pay a 10% penalty if you withdraw earnings on your contributions before age 59 and a half. So that's a brief overview of retirement accounts. The bottom line is it's important to choose an account that fits your needs and helps you start planning for the retirement of your dreams.
So it's really important in terms of you'll earn a lot more on your money if you're able to put it into one of these savings vehicles, a 401k, a 403b, an IRA, because essentially what it's doing is it's letting you pay less tax. Anytime you pay less tax, that legally, that is a good thing. So I want to really encourage you to, as you start to think, as you become financially independent, or if you're already financially independent, to really think about when you save for retirement, to try to do it in a tax advantaged way using one of these different vehicles. I'm going to put into the chat a couple of oops. That's the savings for retirement. It's actually a couple of different ones. Hold on just a moment. There we go. So one of these is saving through an IRA. The other is saving through an employer. Again, I think you've already received these, but if you didn't, now they're in the chat. And it just covers what was talked about in the video. A little slower and you can kind of go through it at your own speed. So when you start receiving money, you'll pay taxes. So now you don't pay. Exactly. So when we talk about those pre-tax plans, basically you take your income, you take out whatever you're saving for retirement, and you only pay tax on that reduced amount until way in the future when you start taking that money out. Two things will be true. One, you've put off paying taxes for a very long time. And two, that money that larger amount of money has been able to grow instead of sort of a smaller amount of money. The Roth is the one that gets taxed right away. But a Roth is really good if you pay very little income tax right now, because it's quite likely if you have a job later, you might pay more taxes in the future. So especially if you're in a really low tax bracket right now, it might make sense to have a Roth. Are there savings accounts that have no penalty for taking out money before a certain age? The Roth sort of does. Because you've already paid taxes on your contribution, if you take your contribution money out, you don't pay taxes or a penalty. If you take out the growth on your contribution, then you end up paying a penalty on that. When will we get the date options? Oh, I'm going to let that one go for someone else who's smarter than me about these things. Okay, so I put these two cases into the chat. How can I simplify my finances? I love to have everything automated. So having my employer or the school direct deposit into my accounts. If I know I want to be saving for retirement, or I want to be saving for my emergency savings fund, have it automatically swept out of my checking account. If it's not there, I'm not going to spend it. And then the last thing is avoid late fees. So try to auto pay, or, I mean, auto pay is great. You just have to make sure you've got money in your account. But it keeps you from forgetting to pay or from being late and getting those $35 or $45 late fees. Okay, key takeaways. Budgeting is what gives you freedom. Freedom from stress, freedom from worry. It gives you freedom to accomplish your goals, all of those wonderful things. What I'd like to do is show you something. This will be available to you. We have an online financial knowledge platform. One of the wonderful things about it is we will never, ever try to sell you something or send you emails or anything like that. So this is not us trying to take advantage or exploit you in any way. There's a learning center with some information on budgeting, saving, credit scores, borrowing, some great topics. The other thing that is super cool is this planning center and the tools. So let me show you like the rainy day savings. So in Kanal's case, his goal was 3 months of $1,500 of living expenses. He had nothing saved, so he needed to save $4,500. And he decided he wanted to try to save $4,500 over 2 years. So this tells him he needs to save $187 a month, right? So although that is a wonderful thing to know, if we come back here and we look at my budget, so this is Kanal's budget. I put in all the numbers that we had talked about previously. Let me just edit it so you can see what it looks like. So here's his paycheck of $29.59, his rent $9.50 a month, utilities, etc. If you come all the way down here to the bottom, do you see rainy day savings, $187 a month? That automatically came in from that other goal that we just talked about. They have the same thing for credit cards. They have the same thing for retirement savings. So what you end up with is this budget where you can kind of see where you're spending your money. You can see that he's $140 a month short right now. So he needs to go in and fix his budget because he can't be short $140 a month. So this is the Babson Financial Literacy online platform. If you are interested, I'm going to actually put this link in the chat. You can sign up for it. Basically, all you have to do is give us your email address.
And Dr. Bethel, I think for this, in the evaluation forms, we also put a way for them to sign up. So then we will add them manually because Robin asked us to add them.
Oh, okay. Okay, great. I'm sorry. And then the final thing is we only improve by having feedback. So we ask two things of you. I've had a wonderful time with all of you this evening. Thank you so much. You've been so engaged and I appreciate it. I know we do want some feedback. The other thing that I'm going to ask, and this is my personal appeal, sharing knowledge is free. And so if you know someone, it could be a family member, a friend, a fellow student, a colleague at work, that you think could benefit from what you've learned tonight, please, please, please share it with them. Because we just want everyone to be able to take control of their finances and reach all those goals that they want to reach. So I'm going to turn it over to Kirk, I believe. I'm not sure who I'm turning it back over to.
Yes.
Okay.
Thank you, Dr. Bethel. So I would like to thank Dr. Bethel again for being here today for this presentation. Also, thank you to our interpreter and captionist for their services this evening, and to everyone for your questions. We have 2 more financial literacy events this semester, so please come out to those if you are interested. There is more information on the ASGCC website for details. Please remember to fill out the WUFU form I have left in the chat below to be entered for the gift card giveaway and to receive credit for this workshop.